Good afternoon, and thank you for joining the National Conference of State Legislatures and the Pew Charitable Trusts for this briefing on Pew's exciting new Fiscal 50 State Trends and Analysis online resource. My name is Luke Martell, and I am a Senior Policy Specialist in the Fiscal Affairs Department of the National Conference of State Legislatures. I will be serving as the moderator of today's webinar. As a reminder, if at any time during this webinar, if you have any difficulty hearing the audio through your computer speakers, please use your telephone to dial in to hear the audio portion. Next slide, please. There. The National Conference of State Legislatures is pleased to partner with the Pew Charitable Trusts to bring this webinar to you. In case you are not familiar with NCSL, we are a bipartisan organization that serves the legislators and staffs of the nation's 50 states, its commonwealths, and territories. NCSL provides research, testimony, and opportunities for lawmakers to exchange ideas on pressing state policy issues. NCSL conducts a variety of research related to state fiscal policy, which we make available on our website. In addition, state fiscal issues fall primarily within the jurisdiction of two NCSL standing committees, the Committee on Budgets and Revenue and the Labor and Economic Development Committee. NCSL's standing committees allow legislators and legislative staff to exchange state experiences in shaping public policy and managing the legislative institution. They meet twice a year at the NCSL Legislative Summit and at the NCSL Fall Forum. For information on these meetings or NCSL's activities and services to legislators and legislative staff, please visit our website at www.ncsl.org. Next slide, please. Our speaker, Barb Roshevitz, is a research director in Pew's State Fiscal Health Project. She oversees the online Fiscal 50 State Trends and Analysis resource and also supervises a research portfolio that enables comparisons over time of states' tax revenue, spending, reserves, employment rates, and other issues important to long-term fiscal health. She leads a team of researchers and writers to produce Pew reports on a variety of topics critical to state and local fiscal health. These have included pension and retiree health care funding in cities, public attitudes toward state budget policy, and the early effects of the Great Recession on states. We look forward to hearing from our distinguished speaker today. Now, I will turn the program over to Barb Roshevitz. Welcome, Barb.
Thank you, Luke. And welcome to everyone who's joining us today. As Luke mentioned, my name is Barb Roshevitz, and I'm here with a few of my colleagues who research state fiscal health. We're pleased to share our new online resource from the Pew Charitable Trusts, and it's called Fiscal 50 State Trends and Analysis. Fiscal 50 allows you to sort 50 state data on a select group of fiscal, demographic, and economic indicators. You can see your state's data over time as a trend, or compare yourself to a neighbor or a state with similar challenges or resources, or to a national benchmark. In addition, Pew provides short analysis that puts the data into context, so you can quickly grasp how you can talk about the findings for your state. We are purposely selective in what we present. We don't want to overwhelm you with data. In addition, we know you already have access to a lot of excellent survey data on current state budget conditions and tax actions from NCSL, as well as fiscal data from other organizations like the National Association of State Budget Officers and the Census. But here's how Fiscal 50 stands out, we think. The focus is on states' long-term fiscal health. Emphasis there on long-term. We choose performance measures that help you think outside the budget bubble. Each indicator that we have published so far will help you focus on the big picture so that you can focus on issues beyond balancing the budget that will have lasting effects on your state's fiscal health. With all but a handful of states now launching into new legislative sessions, this is a particularly good time to stand back before your session revs up and see how your state is doing on these long-term fiscal health measures. Today, I'm going to demonstrate what you can see and learn from Fiscal 50. And I'm going to give you 5 takeaways from these trends that will help you examine your state's progress. To begin, as you can see on this screen, Fiscal 50 identified 5 core areas that are essential to states' financial well-being: revenue, spending, economy and people, long-term costs, and fiscal policy. Then we drilled down into each of those core areas to identify and analyze trends using 50-state data. So far, we feature 6 indicators, which we will be updating regularly. But we also plan to grow this content and selectively add other indicators that will provide insights into states' fiscal health, and we'll be adding occasional analysis. Now for your first takeaway from Fiscal 50. With several states ending fiscal year 13 with modest surpluses, including some surprising turnarounds as in California, you may encounter assumptions that state tax revenues have bounced back from the Great Recession. Here we look at quarterly tax revenue, and unique to Pew, we adjust it for inflation and across the previous 4 quarters for each state to show where state tax collections are compared with each state's own peak. So, how far have state tax collections bounced back since they plunged in the Great Recession? In unadjusted dollars, total state tax collections, that is for all 50 states combined, made up their losses in the recession in the middle of 2012. That is in unadjusted dollars. But you get a different perspective when you look at inflation-adjusted dollars, as you see here. This gets at how much purchasing power a state has. For the first time since the recession, states just barely surpassed their previous peak level at that last data point, which is the middle of 2013, after adjusting for inflation. Basically, that's the end of fiscal 2013 for most states. That is a full year since the recession ended. It took 14 straight quarters of revenue growth to make up for the 13% drop experienced by the 50 states combined. Another way to read this is that for every $1 states collected at their peak in 2008, they took in the equivalent of about 87 cents at that low point in the final quarter of 2013. And at the end of fiscal 2013, they were taking in just a half cent more for every $1 they took in 2008. While this is a milestone, surpassing the peak for the 50 states, it doesn't mean state revenue has fully recovered. If you took California and New York revenues out of this data, in fact, the other 40 states altogether wouldn't yet have broken even. Plus, one of the things that pushed tax collections over peak was one-time revenue, as some taxpayers took gains early before federal tax cuts for certain income levels were scheduled to expire in 2013. According to our data, every state saw declines in their purchasing power once we adjusted their tax revenue for inflation, and most saw double-digit declines at some points. But a few took softer hits to their tax collections. Let's look at a state. Florida. Its economy, of course, was hard hit by the housing bust. Home prices plummeted and its foreclosure rates were among the highest in the nation. As you can see here, its tax collections actually peaked in 2006, before the Great Recession even began. Florida's tax collections soon fell below the 20-state benchmark and are still below. At its depths, Florida's tax revenue fell to 27% below its peak and still ends at 21% down as of June 2013. Only Alaska and Wyoming were still farther behind where they once were in tax collections. Now, contrast that with Arkansas, which you'll see here in green. It saw its revenue dip the least of any of the 50 states. At its lowest point, tax collections dropped 4% in the third quarter of 2009, and its inflation-adjusted tax revenue was fully recovered midway through 2011 and is now 5.1% above peak. The state has consistently performed better than the 50-state total. Fiscal 50 allows you to see results like these for each state. You can even take screenshots of the trend line to add to your reports, or you can download the data right from the tool itself if you want to examine a spreadsheet or if you want to graph it yourself. Now, to answer my question, have states recovered? As Florida and Arkansas illustrate, well, it matters where you live. In fact, a majority of states have not yet gotten back to where they were. Let me take you through a time lapse of states' tax revenue from the beginning of 2009 up to the most recent data available. Okay, what you need to know to understand this time lapse is that orange signifies below peak, dark orange is more than 15% below peak, blue signals a state has begun recovering its tax revenue. As I mentioned, this starts out with all states in orange. Because a year after the recession started and 6 months before it ended, all state budgets were feeling the effects of the downturn. Here's our current picture based on the most recent data. In inflation-adjusted terms, only 20 states' tax revenue, the ones you see in blue, was back up to its high before state revenue crashed following the mortgage and financial crisis. And even though they are over peak, that does not even take into account population increases, increases in school-age children, growth in Medicaid enrollment, or other deferred needs that can put additional strain on state budgets. Now, in contrast, if you just looked at unadjusted dollars, you would have the perception that revenue had recovered in 35 states. So, did your state end as orange, with less purchasing power than when the recession started, or did it end blue? You can visit Fiscal 50 online to see your state's trend over this period. Let me at least, though, show you the leaders and the laggards. It probably doesn't surprise you that North Dakota led the nation as it rode its oil boom. Its tax revenue is 91% above its highest point during the recession. But not every state's revenue increase can be attributed to the economy as it is in North Dakota. In second place is Illinois, with a 20% increase in revenue over its recession peak level, thanks largely to an income tax increase. Alaska shows up farthest from peak, down 51.7% from its high mark. But I hasten to add that's mostly because Alaska's revenue had a short-lived spike in tax collections in 2008. That was when crude prices spiked to an all-time high, just as the state windfall profit tax took effect. So clearly, the recovery is uneven, and 30 states are still behind in tax collections after adjusting for inflation. The second takeaway is the crucial fact that states are coming off a time when their reliance on federal dollars has never been higher. That has ramifications for states as the federal government tightens its belt for the foreseeable future. We can see states' reliance on federal dollars by examining both revenue and spending. First, let's look at the revenue side. In this indicator, we calculate year by year the share of state revenue that comes from federal dollars. Now, going back to 1961, which is far back as the 50-state data go, the federal government has provided, on average, about 1/4 to 1/3 of states' general revenue. In poor economic times, the federal share tends to rise as state revenues fall and federal dollars for entitlement programs such as Medicaid continue, or in the case of the most recent recession, rise. Here you can see how the percentage of state revenue coming from federal dollars rose after both of the last recessions. It was due to two things. Federal aid increased temporarily, and likewise states' own revenue fell. So this is a ratio. But since the Great Recession, notice this. States' reliance on federal dollars is the highest it's been in 50 years, as far back as that 50-state data go. After the recession, federal funds accounted for 1 of every $3 in state revenue, as you can see peaking there in 2010 and then a little drop, but still very high in 2011. When the Census Bureau releases new data in a couple of weeks, we will update our indicator, and you will be able to see what happened as federal stimulus dollars fell off sharply in fiscal 2012, and to what extent state tax revenue grew enough to make up for a loss of federal dollars. Now, you all have already lived through this fiscal cliff with the the expiration of stimulus dollars, particularly for Medicaid, but we know that there are new pressures with the budget deal recently struck in Congress. While it relents on some of the across-the-board spending cuts, it still keeps the brakes on federal spending. In addition, the Affordable Care Act will have a big effect on this ratio, as more Medicaid dollars start going to expansion dates. This likely will add to the variation we already see in the role of federal dollars in states. So let's take a look at that variation. Here are the states where federal dollars make up the greatest and smallest shares of their general state revenues. Now this is a measure that's broader than the general fund revenue in state budgets. The green line shows Mississippi, the state with the highest proportion of revenue from federal dollars in fiscal 2011 at 48.8%. Now Mississippi also has the highest federal Medicaid payment level, which accounts for a lot of this. In orange, the state with the smallest share is Alaska at 24% in the most recent data. As of 2011, federal funds made up more than 40% of state revenue in 9 states, including, as you can see here, Mississippi, Louisiana, and South Dakota. And federal funds made up less than 30% of state revenue in 10 states, including those with the least revenue share, Alaska, Delaware, and Nevada. Now let's take a look at the results of federal dollars on state spending. Rather than track growth in spending from year to year, the way you more often see it done, we provide a different view by calculating spending as a share of state personal income. We look at the 20-year trend in spending from total funds, that is, state and federal dollars together, and compare it to spending from state funds alone. Again, we use census data to capture far more than just general fund spending because it includes things like capital outlays and spending by related units of government. So this is a broad, big picture of spending. Here's the 20-year trend for all 50 states in aggregate. In light blue, you can see total spending. This is, again, both state and federal dollars as a share of the economy. By this measure, you can see that, in fact, after the Great Recession, at a time that state budgets were extremely squeezed, total spending by state governments actually rose as a share of the economy. In fact, it hit its highest level in at least 20 years, in fiscal years 2010 and 2011. Now these, again, are the years that states received their largest doses of temporary economic stimulus aid from the federal government. To understand this graphic, here are the numbers. Total state spending went from 11.9% of state personal income in fiscal year 1992 to 12.9% of state personal income in 2011. That's how we get the 1 percentage point increase. Now I'm going to add state-only spending. These are state figures, state funds alone, and this is the figure that we calculated at Pew. You can see that for all 50 states combined, spending from states' own resources was down as a share of the economy. Comparing 1992 to 2011, spending from states' own sources went down from 8.6 to 8.3% of state personal income, a drop of 0.3 percentage points. So more than the numbers, just consider the trend lines. How is it that total spending was up, even though state spending from its own sources was down? The answer, federal funds. Federal funds made the difference. Overall, federal funds have largely driven growth in total state spending in the wake of the recent recession, but also over the past 2 decades. Now we see this indicator as being most useful in comparing a state to itself over time, rather than ranking states by how large their state expenditures are as a share of their economy. That's because there's no one right size for state government spending. The value in this measure is that it provides some analytics to determine how a state wants to use its purchasing power over the long term. Fiscal 50 shows you the 20-year trend for each state. Here's one example of how this can be illuminating. Now, North Dakota has seen its general fund biennial budget more than double between 2001 and the budget ending in 2013. But the perspective is different when changes in spending are compared to changes in state personal income, which takes account of population and industrial growth in the state. I just added the share of spending from state funds alone. The state's oil boom began in 2006. So if you can study this graph, you can see that while state spending has grown somewhat since 2006, spending from state and local funds as of 2011 was still lower as a share of the economy than it was in the early 1990s. And that was true for both total spending, including federal dollars, and what it spent from its own sources. Again, more important than the specific numbers are the trends. And going back to my takeaway, the role of federal dollars is greater than ever. In every state, the share of spending fueled by federal dollars was higher than it was 20 years earlier. So, if federal funds rose as a share of the economy in every state, what accounts for the different outcomes we found when we compared the trend lines for each state? We found that states fell into 3 categories. Let's look first at the blue states. In these 19 states, spending grew more than the economy compared with 20 years earlier, whether from federal funds alone, state funds alone, or total funds. Now let's look at one state, and I think it'll be easier to understand what I'm talking about in terms of the trends. And we'll look at California. And you can see a breakdown like this again for every state. Here's how California's spending has changed as a share of its economy since 1992. All of these categories of spending are higher than 20 years earlier, using this broad measure of spending. We can see that either spending grew more than the economy, or perhaps spending stayed the same and the economy shrunk. Either way, spending by this measure increased overall. Now we'll look at the brown states. In these, another trend was going on. These 19 states also had a higher level of total spending in 2011 than 20 years earlier, like those blue states. But in this case, another trend also was going on. Here, total spending rose, but it was only thanks to the increase in federal funds, because what states spent from their own resources was down. Here's the breakdown that'll help you understand this for one of those states. Arizona. Among this group of 19 states, Arizona had the largest decrease in spending from state funds alone, shown here by the orange bar that you see at negative 2.1 percentage points. Still, look at the increase in federal funds, 2.4% of state personal income. So the federal funds more than made up for the drop in state funds. Thus, total spending still was higher in the wake of the Great Recession than it was in 1992. Interestingly, though, when it comes to what Arizona spent from its own funds alone, we found that Arizona spent less as a share of its economy in 2011 than at any time in at least 50 years. The last group of states is where total spending also has decreased. Across the U.S., 12 states saw total spending fall over the 20 years as a share of state personal income. What this means is that total state spending did not grow as much as the economy did, or that spending actually went down and the economy stayed the same. Now notice here, North Dakota is among this group. And that might surprise you since I'm talking about spending decreasing. But remember, we're not looking at how much the state actually spent in dollars, but how much it spent compared to its economy. You can see here that both total spending and spending from state funds alone are down. The reason that North Dakota's spending is lower than 20 years ago is that its economy took off following the discovery of oil in the Parshall oil field in 2006. But even though the state increased its budget after that to start meeting the growing needs for roads and schools and other services that came with its oil boom, its spending has grown somewhat, but it is still lower than the early 1990s. Now that provides some valuable context for debates going on in North Dakota currently over how much it should increase its budget to pay for new demands on infrastructure, education, and other services. Now we'll keep talking about spending, but I'll shift gears to talk about spending commitments, and specifically those that do not come due for years. The third takeaway is meant to enlighten policymakers on long-term obligations, because decisions by policymakers today on these claims will influence state fiscal health even decades down the road. With this measure, we compare unfunded pension liabilities, unfunded retiree health care, and public debt, all long-term obligations that place a claim on future spending. Of course, states also face other long-term budget pressures, such as deferred maintenance and upgrades to infrastructure, but there's not comparable 50-state data for all of those, at least at this moment. In dollar terms, the 50 states combined owed more for unfunded pension benefits, as you see in aqua, than for either debt or unfunded retiree health care. As of fiscal 2010, states owed $575 billion for unfunded pensions. That's versus $704 billion for public debt and $625 billion for unfunded retiree health care. Now, there are several reasons to care about these obligations. One, if annual costs for these obligations get too burdensome, states might have to cut other services like education to make payments, or they might have to raise taxes. Another is that credit rating agencies watch these same obligations, and if they're seen as problematic, states' credit ratings could be lowered, and that raises borrowing costs for roads and schools and other essential investments that require that kind of long-term financing. Now, we recognize that these three types of obligations are not created equal. Debt is a vital tool for building infrastructure projects, and it can spur economic growth and deliver services for years in the future. Whereas unfunded pension and retiree health care liabilities represent bills for services already rendered. When those costs aren't paid each year, the result is the bill is merely passed on to future generations, and those future generations never receive the services of those government workers. Yet all three of these obligations share one important trait. They are all claims on future state revenue that can put pressure on state finances. Of the three types of obligations that we examined, we categorized them by which states had the greatest liability from which obligation. We found that unfunded pension liabilities were the largest in 31 states. So the majority of states have the biggest problem with unfunded pension liabilities. And in fact, unfunded pensions were more than half of the total long-term costs in 20 of those states. Unfunded retiree health care was the largest future cost facing 11 states. And in fact, it was more than half the total in Delaware, Michigan, North Carolina, and Texas. Lastly, public debt was largest of these long-term costs facing 8 states. And it made up more than half of total obligations in 7 of those states, all except California. As I mentioned earlier, debt can be a force for good in a state. In fact, These states where debt was the largest outstanding obligation have among the highest credit ratings from Moody's, except for California, which has been downgraded for several reasons not directly related to any of these particular long-term costs. Massachusetts' debt, for instance, looks high compared to its pensions and retiree health care, but one thing to keep in mind is that it often issues debt on behalf of its locality, so its number looks larger. Here are some of the kind of comparisons you might find interesting. This looks at the 3 largest states. As you can see, debt, darker blue, is the largest obligation in California and New York, while retiree health care in green tops the list of long-term claims on Texas's future revenues. Now, whether these claims are a fiscal problem for a state depends on the state. So, for example, states with faster growing economies are better able to manage these costs. Now let's look at the smaller states. Among the least populous, pensions in Aqua stand out in Wyoming and North Dakota. Meanwhile, in Vermont, pension underfunding is smaller than either its retiree health care obligation or debt. I'm sure you are all aware of your own state's long-term obligations, though perhaps not in comparison with other types of obligations. In recent years, many states have taken steps to address their unfunded pension liabilities, though not every state has, and many still have more work to do. But when it comes to retiree health care, as of 2010, only 7 states had funded even 25% of their promises, and 17 had set aside 0. So particularly as the baby boom generation retires, this is a long-term obligation that will need managing. Now we turn to something that I think is topmost in most state policymakers' minds this legislative session, and that is jobs. We include a category for economic indicators because they have fiscal effects. Clearly, the job situation is important for state government, both because it affects tax revenues, but also because joblessness can mean higher costs, as in assistance programs. Here's what's different from what you most often read and hear about the job situation. Mostly you see the unemployment rate, but that fails to count workers who stop looking for a job. It doesn't count underemployment or long-term unemployment. So the key takeaway here is to suggest an alternate way of looking at jobs growth in your state. Rather than looking at unemployment, we look at employment. Former Fed Chairman Ben Bernanke said unemployment rates overstate the health of labor markets. So economists tend to like an employment to population ratio for a truer sense of the labor market. It takes population growth into account. Moreover, we've narrowed it down to those in their prime working years, ages 25 to 54. We do that so that the trends are not distorted by college students and retirees. In addition, we avoid the ups and downs you often see in jobs reports by looking at average results over a year for a truer picture of what's happening in the state. Again, we're taking the longer-term view. That helps avoid the sort of confusing information such as came out last week. First, the payroll processor ADP reported more jobs were created than expected. 238,000 jobs in December, they said, and that led to optimism that the U.S. economy was rousing again. But a few days later, that optimism was dashed when lower job numbers came out from the Labor Department, which said only 74,000 jobs had been created in December, and the unemployment rate had dropped. What we found is that in 2007, leading up to the recession, nearly 80 of every 100 people ages 25 to 54 in the U.S. had a job. Flash forward to the 12 months ending June 2013, well after the recession ended. Only about 76 of every 100 in that age group were working. So for every 100 prime-age workers in the U.S. in 2013, 4 fewer were working this year than were before the recession. Now let's look at an individual state. Nevada. In 2007, 82 of every 100 prime age workers had a job in Nevada. In 2013, only 74 of every 100 were employed. So for every 100 workers in this age group, 8 fewer were working than before the recession hit in 2007. By this measure, Nevada is furthest from its pre-recession employment rate of any of the 50 states, which kind of isn't surprising because it is tied with Rhode Island for the worst unemployment rate as well at 9.0% for November. So what we've measured here, what you see circled in red, the 8 fewer working in Nevada and the 4 fewer working in the U.S. in 2007, is what we measured for all 50 states. By this measurement, no state, not even Texas, with all its job creation, had a statistically significant increase in the number of prime age workers with a job compared with its pre-recession level. We will be getting new data later this month so we can look at the employment rates for all of 2013 rather than for fiscal 2013 as we look at here. 35 states had statistically significant decreases, the largest Nevada, followed by New Mexico, Florida, Arizona, Montana. Now at the bottom you can see that Nebraska and Vermont had the smallest observable difference compared to 2007. But given these statistics, which are based on survey data, this could be an increase, it could be a decrease. There is no way to be sure based on the survey data. You have to consider that it's like a margin of error in a political poll, that it could be up or down either way. Now, in the case of Texas, even though 473,000 jobs were created from 2007 to 2012, the difference is its net population also increased by $2.2 million. So in fact, while Texas had created jobs, it also had one of the fastest growth rates for population of any of the states. So takeaway number 4 is that even though the unemployment rate is dropping, labor markets in the states have not recovered from the recession, particularly when population growth is taken into account. Lastly, we're going to take a look at ending balances and rainy day funds. Now this is based on data that states report themselves to the National Association of State Budget Officers. The only thing we do differently here is that we calculate how long each state could run in days just on states' general funds. And that's just a simple way to compare states. As this trend line for the 50-state median shows, state governments tap their reserves after both recessions this century to help absorb some of the shock of plummeting revenues. Here you can see that states are building back their reserves as their revenue returns. According to what they expected to have at the end of fiscal 2013, half of states expected to have enough financial cushion to cover about 30 days, about a month's worth of operating expenses in fiscal 2013. Still, that's 11 days short of pre-recession levels in fiscal 2007 of 41 days. So the final takeaway is that recovery now gives states a chance to take a lesson from the Great Recession when it comes to their financial cushion. Were reserves sufficient heading into the downturn? Did the policies for replenishing those reserves meet the state's needs? One of the factors related to reserves is revenue volatility. Reserves are supposed to smooth out that volatility. Pew in coming weeks will be issuing a report that will help states assess their own state's revenue volatility. Let's look at the state with the greatest reserve. That is Alaska. It reported 794 days worth of operating expenses on hand, and that's not even counting its permanent fund, which pays dividends to residents as well as saves for the future as the state's oil reserves are depleted. Contrast that with Illinois. Illinois' financial cushion was nearly the smallest at just under 2 days. Because Alaska is so large, I've taken it out of the next chart, not counting Alaska. These states expected to have the greatest financial cushions as of the end of fiscal 2013. North Dakota, Wyoming, West Virginia, Nebraska. Notice these are all states with minerals or agricultural resources. At the other end of the spectrum, 3 states expected to have less than 5 days worth of reserves on hand. Arkansas, Illinois, California, New Jersey is 5.4, and Arkansas reports 0. Arkansas reports 0 routinely to NASMO because of the way that they interpret the survey. So we're including them at 0 because that's how they report the data. Now you can see your state's ranking along with whether it is above or below the 50-state median at fiscal 50. So to recap then, here are the takeaways that may help you think about your state's challenges when it comes to long-term fiscal health. States are still dealing with the after effects of the recession. A majority of states still have less purchasing power than before their tax revenues plunged in the recession. Unemployment rates are down, but most states aren't creating enough jobs to keep up with population growth. And reserves are still below pre-recession levels. On the federal funds horizon, the prospect of further federal belt tightening comes as states' reliance on federal dollars has been particularly high. And there are some unavoidable financial pressures lurking down the road. Could be in the form of unfunded retirement costs for some states, maybe other obligations for others. These aren't always captured in debates about balancing the annual state budget, but they still deserve attention for the sake of states' long-term fiscal health. So just to give you an idea, we will be updating fiscal 50 as new data comes in for each of these indicators, and we'll be adding fresh analysis each time we update. We also expect to be adding a few more indicators as we grow fiscal 50. We'd be interested now or at any time, too, in hearing what sort of indicators you would find useful. So thanks very much for listening, and we'll hang tight and maybe be able to answer some questions.
Thank you, Barb. At this time, we are happy to take questions. To ask a question, please type it into the Q&A box on the right-hand corner of your screen. As we are waiting for questions, I want to let you know that this webinar is being recorded and will be archived on the NCSL website, and we will also post a version of the PowerPoint slides. And for the first question, it's Barb, what will fiscal 50 look at next?
We currently are looking at a couple that we're gathering data for right now. One is we really want to take a look at Medicaid spending because it is such a large part of the spending by states and involves a lot of federal dollars as well, so we have a lot of reasons we're interested in it. And another one that we're looking at are states' poverty rates, and we're still making decisions about what is the best way to portray poverty rates, not just reporting poverty rates, but we're trying to look at something else that may help policymakers target which populations they might want to pay the most attention to. Anyway, we're still examining it. In addition, we have ideas in the works to look at transportation spending for one, maybe changes in spending or changes in states' tax revenue streams as well. And as I'd mentioned, we're still entertaining ideas for what else policymakers would find useful, because the main purpose of this tool is, as we'd mentioned, to kind of raise issues in states. This may not always tell you why something has happened, but we're hoping that it will prod someone in the state to try to figure out why their state is a laggard on some particular indicator if they don't want to be a laggard. Or if a state is a leader, maybe others could look to it to get some hints on what policies they may have put in place that could be helpful for them to replicate that.
Thank you. Will Pew announce future data updates? Is there an email list that people can subscribe to?
Well, we're hoping actually to work through organizations like NCSL and CSG and others. Whenever we update the data, in addition, we'll be tweeting and doing, our own promotional material whenever we update an indicator.
Thank you. How do you define state revenue? Is it all sources in the state budget or just the general fund?
The tax revenue indicator is what census looks at. It comes from the quarterly state tax revenue data that they collect. And it includes all state-based taxes and some fees, even hunting fees and things like that. So it's a little broader than just whatever is in the state budget. The state budget may have different definitions. So if you go to the website as well and look at our tax revenue indicator, there's a little box down below where you can see a methodology and sources, and it will have links and a definition of everything that we've done there. And you would also find our analysis that we've written on each of these indicators. The hope with that analysis is actually that we're putting into words what we see happening in this trend, and what we're suggesting is that you can look at your own data and basically substitute your state's name and your state's numbers for the way that we've written something, so that you're going to be able to talk about these trends as well.
All right, for the next question, why did you choose these 6 indicators to start?
We spent a lot of time looking at state finances, thinking about state finances in general. And we actually conferred with a lot of budget practitioners in the states and also some academics about what is it that really defines state fiscal health. And we just gravitated toward these 5 buckets that we had. And then we thought about, in each of those buckets, 2 questions basically. Which of these would be most important about giving a state a sense of where it is, particularly compared to other states or compared nationally? And then secondly, we're limited by what data we can get on a 50-state basis, and that's a trying challenge. We would love to have, for example, better spending data even than what we're able to get, but there's a lot of information that we'd like to have that is just not reported in a comparable way across states. And one of the rubrics, as we were putting this together, is that we sought indicators that we thought you can get data that can be updated and that you can present and would be fair to states as well.
Thank you. The next question is, will you look at the effect of privatization on state spending?
Well, privatization won't be something that we will look at specifically, or we don't have a plan for it at this point. It could in some ways show up in the spending indicator. If there were a lot of it, maybe you would see the results of it. And one of the things we've also talked about looking into is transportation spending, and so it's possible that we would see the effects of it. I don't now have on my list, but maybe now we'll add looking at this idea of privatization if there is enough across the state to actually look at. Again, we have the problem of how do we collect data and make it comparable across all states.
And if we can go to the next slide, this brings us to the conclusion of this webinar. If you have any questions following this event, please feel free to contact me. And next slide again. My contact information is listed on the screen now. And as a reminder, the full text, the full recording of this webinar is available on NCSL's website, and there's the link to the Pew report. Lastly, please take a moment to share your feedback on this webinar by taking the short survey that pops up at the very end. Thank you very much for your interest and participation today.